Right. Morning, everyone. Welcome back to Morning Kappa at 8, Joseph here. So looking at the Hang Seng market, right? Hang Seng market is undergoing consolidations right now, but it still stay above our key support level of 25,000 point level, eyeing to break past the 26,000 point. So we just remain bullish buyers on the Hang Seng index. Now, meanwhile, just want to update that yesterday night, one major news that actually affect on the market, which is the U.S. Treasury that led by Besant decided to buy on the U.S. long-term bond. The net effect is that the U.S. long-term bond yield actually move downwards, and what you see another effect is that the dollar DXY have actually came down. So as the you can see that last 2 weeks, right, U.S. also start to buying in the yen, right? When they're buying in the yen, what happened is that the dollar also get weakened. So after they buy the yen, and yesterday they lowered down their US interest rate, right? Both policy actually give market impressions that the dollar is going to have more room on the downside. As such, you can see that the gold have actually went up yesterday. So while the gold went up yesterday, I think 2 days ago during our morning kappa, I share with you this phenomenal that I say contango, right? What I do see is that right now commodity is going on a very bullish setup right now. So apart from a gold, we're also looking at the crude oil. At this juncture, the crude oil is hovering at the 86 level, right? Break above 86 should see the gold, should see the oil moving above 90 or 93 level, right? Although right now the report is having bearish bias, but I just wish everyone here to take note that commodity market have a very bullish setup right now. We look at our the FCPO, right? Also, yesterday, right, about to break the 4,009, right? And this actually shows that be it the hard commodities, soft commodities, or even the precious metal, right, are all are actually showing a very strong bullish setup now. And I think one of the key effect is that the DXY have actually went lower. Number one, the dollar have been weakened. Secondly, is that markets actually worry on the supply side of things, especially for the oil, right, and also the pump, right? So I think just monitor the development over here. Then on, let's after we have talked about the commodities market, let's also look at the stock market. Right? So in the Hong Kong market, I'm just waiting for the Alibaba to announce their results today, which is the 20th of August. At this level, right, I think the Alibaba is still showing me a bullish setup that I'm waiting it to break 128. Then on the downside, right, the support should be at 118, right? Even if Alibaba move slightly downwards, right, based on the volume profile, you can see that a very strong support should emerge at 110, right? So this is the one of the volume profile chart that I'll be looking at whenever if you want to trade on the Alibaba, right? Then on the US side of things, or in the Asian market, this morning we monitor the development of the Nikkei, as we can see that Nikkei for the past 2 days experienced a very sharp corrections, but on the downside, I do see a support at a 61800 point level. So after the US have revised their uh, the central bank have started to step in to buy their bonds. Let's see what happened to the Nikkei market this morning. At this juncture, right, I still stay on the bullish side of things for the Nikkei market. Now, as for the tonight on the US market, apart from the Alibaba, the counter called Alibaba, right? I also look at the oil company, which is the ExxonMobil, XOM, as well as Johnson and Johnson, J&J, which are both also showing a bullish setup right now. Then on in the Malaysia market, as we mentioned, the dollar has been weakening, right? What we do see for the past three sessions is that the ringgit have actually went on stronger, right? that also be one of the reason why we can see that our exporters, especially the E&E, are moving sideways right now. But I think that generally when the ringgit goes stronger, we can actually look at the domestic market. So for uh, our domestic market, I'll be looking at Summit Medical, where they are going to announce the results today, right? Based on the chart, you can see that Summit Medical underwent a mild corrections last week. This week, they have actually recovered the losses, and right now heading towards 2 ringgit and 10 cents, right? And at this juncture, research Eddy still have a buy call on the Summit Medical. So if breakout happen, it should move towards 2 ringgit 25 downside. I think the strong major support will be at 1 ringgit and 80 cents. Okay. Now, apart from Survey Medical, right, another tech stock that have a breakout yesterday was the Synergens. It break above 69 cents, and in fact, you look at the Synergens, you have a breakout way before at 62 cent and half. So upside, it could move towards 75 and followed by 80 cents, right? So apart from Sunway Medical, Synergens, and other stocks that gathered my attention was HE Group. They have an analyst briefing yesterday. I think the sentiment still remain positive. You can see that post briefing, right? The HE Group still stay above 87 cents. So based on what I learned yesterday, that HE Group now has become more aggressive into the data center, right? And they have both. They are actually servicing the data center as well as the semicon players. So right now, I think the chart what's telling me is that the counter is actually very bullish right now, and potentially move towards 97 cents and followed by 1 ringgit and 5 cents. So on the downside, right, be a bit cautious that set the major support or stop loss point at 81 cents. So you can look at one of the domestic stocks here, HG Group. Now then on, as for the IMAN, right, you see that opportunity on the massing, which break past 1 ringgit and 15 cents on the back of a high volume. So after the breakout, massing could climb towards 1 ringgit and 25 cents and followed by 1 ringgit and 30 cents. Also supports 1 ringgit and 10 cents. And then on, we have a Spritzer, also trading at a record high right now, breaking past 3 ringgit and 10 cents. So next R1 will be at 3 ringgit and 30 cents and followed by higher resistance or R2 at 3 ringgit and 50 cents. Downside support is 2 ringgit and 90 cents. So we have two breakout stocks, Massing and followed by Spritzer. Okay, I'll stop here and pass on the sessions to Max. Thank you.
Sorry, Max. There's no audio coming from your side.
Can you hear me?
Yeah, now okay.
Okay, great. Thanks. Yes. Yeah. So we just issued a report on YTL Power. We maintain our buy call with a target price of 6 ringgit and 35 cents. YTL Power remains one of the topic for the utility sector. So yesterday evening, YTL announced that it will acquire a land in Sedenak Tech Park West, and will basically build a 1 gigawatts of data center capacity on 145 acres of land. There is also an option to acquire another 400 acres of land for future expansion. Essentially, if assuming if YTL do exercise the option, it will hold a total land size of about 545 acres in Sedenak. This spot is roughly about 30 kilometers away from the existing YTL Green Data Center in Kulai. But management not disclosed in terms of the cost of acquisition. But where this where this land sits is actually it sits within the IB Tech, which is what you call the Ibrahim Technopolis, which is a master development plan under Johor Land. Essentially, the whole land area is a development that is part of the Johor Singapore Special Economic Zone, and this area step, or what you call step, essentially is positioned as a DC hub within the area. assuming if YTL Power do expand the capacity of 1 gigawatts within our current assumption of 8 years, in addition to the base current assumption of 1.2 gigawatts in Kulai, we do estimate a 32% upside to from our current target price, which will arrive at about fair value of 8.40 ringgit. Currently, we make no changes to our numbers, but this bull case fair value gives you a good idea of what sort of valuation it sort of ramps up to about 2.2 gigawatts of capacity in Johor alone from these two sites. Of course, this does not include the additional upside if they do exercise the option to acquire the remaining, the additional 400 acres of land. YTL have their results coming out after the market closes tonight with a briefing at 7 p.m. So in maintain numbers, we continue to look out for more further data center updates from management, and of course with the impending targeted listing of the data center business by middle of next year. I'll stop here and I'll pass the time now to our colleague. Thank you.
Hi, morning. So I have a result review on Petronas Chemical. So we have downgraded Petronas Chemical from buy to neutral with a new target price of 4.96 ringgit from our previous target price of 5.92 ringgit. And the first half 26 core earnings came in below both ours and consensus expectation at 808 million, representing 41% and 42% of FY26 forecast. So the shortfall was mainly attributable to weaker than expected plant utilization, which averaged about 73% in second quarter, while the first quarter was 97%. Particularly in the O&D, the olefin and derivative segment, where utilization fell to 56.3% amid extensive turnaround activity. So we were expecting the utilization rate to fell off, but then we did not expect it to be this much of extent. So for the segmental performance, all three segments did well. It was just not as good as what we expected. For the O&D segment, it recorded a lower revenue of 2.7 billion ringgit as sales volume declined 33.2% Q-on-Q to 617 tons, and plant utilization fell to 56.3%, partially offset by improved product spreads. The F&M segment saw revenue rise 38.1% Q-on-Q to 3.7 billion ringgit, driven by stronger product spreads and higher contribution from strategic sourcing and trading activities. So the specialty segment delivered a stronger underlying performance, with revenue increasing 7.3% Q-on-Q to 1.5 billion ringgit, while operational EBITDA rose to 140 million. This is comparing to first quarter 26, which is 66 million, where we are excluding the 132 million ringgit emission right gain recognized in first quarter 26. So the improvement was supported by stronger pricing, commercial optimization, and cost discipline. So consequently, the group EBITDA increased 12% Q-on-Q to 1.3 billion ringgit, mainly supported by the firmer product spreads and the higher contribution from value creation and cost optimization effort. So as for outlook, we expect second half earnings to remain resilient, supported by a gradual recovery in the utilization following the extensive second quarter turnaround activity. So management guided for group utilization of 80 to 85% in third quarter and 93% in the fourth quarter, with no major plant turnaround in the fourth quarter. However, the ongoing shutdown of the Kerteh olefin cracker remains a key operational risk, while product prices and spreads are set to moderate from their second quarter 26 peak. So we therefore expect the recovery in utilization to largely offset weaker product spreads, resulting in broadly stable earnings in second half. So we have cut our FY26 core earnings forecast by 19% to 1.6 billion ringgit from 1.95 billion ringgit, primarily reflecting lower than expected plant utilization in the second quarter. So we have revised our O&D utilization assumption to 76% from 80%, lowering our group assumption to 83% from 85%. Following the weaker than expected second quarter operational performance. So we have also lowered our TP to 4.96 based on the 1.1 times FY26 price to book value. And we have incorporated a 4% ESG discount on this. So that's all from me. I'll pass on to my next colleague, Eddy. Thanks.
Thank you, Leon. Good morning, all. I have a company update on KPJ. This is following their analyst briefing yesterday. So all in, we did leave our 2026 to 2028 earnings forecast for KPJ by 9%. This is to reflect a stronger operating profit. We now assume that second half core earnings of 258 million, which is up 10% year on year if you were to compare second half versus second half of this year. Which we think is achievable, given that, given the first half 26 run rate and management's guidance for sequential margin improvements into second half, which should continue to be supported by its underlying strategy to focus on yield per bed per annum. Some of the key takeaways here from the briefing, number one, it's the narrower gestation drag. So within its portfolio of gestation hospitals as well as loss-making hospitals, there's 5 hospitals in total, and all 5 of these remain PAT negative, right? But again, all 5 is EBITDA positive. It's just that PAT remains negative. But what we saw in first half is that the aggregate drag was narrowing 23% year on year in the first half. So the improvements were driven largely by narrowing losses at Damansara Specialist Hospital 2 as well as Kuala Selangor. We do understand that Kuala Selangor and Batu Pahat, these two could turn positive, PAT positive by end of this year or early 2027. In terms of some of the updates on its Center of Excellence hospitals, so Johor Specialist has a COE called Heart and Lung. The heart and lung related revenue has actually grew more than 30% year on year. Similarly, in DSH2, Damansara Specialist Hospital 2, its neuroscience and stroke actually posted more than double-digit growth. These two, following the establishment of its Center of Excellence. The Penang Orthopedic Center of Excellence, it's a bit too new to disclose its performance, but they are looking at opening a 4th Center of Excellence, which relates to oncology, and it's targeted for establishment by end of this year, basically. The idea here is that, as Center of Excellence progressively comes online, they do target 15 COEs by 2030 within its 5 years plan. So as this comes online, KBJ could retain a broader range of high complexity cases that were previously referred to competitors due to capability gaps. So in short, this should actually drive inpatient equity as well as volumes. And lastly, I think Medi Asas was also touched on the briefing. One of the interesting key takeaways we find is that KPJ did argue for its geographic reach, meaning to say, management highlighted that its nationwide footprint, they highlight its nationwide footprint versus peers with 4 or 5 assets, which are mainly concentrated in Klang Valley or Penang. They did argue that it could be logical to grant tier 1 status to a group lacking national reach. So Medi Asas, again, there's 2 tiers. Tier 1, usually you have lower co-payments. Tier 2, the patients themselves would have to pay a higher co-payment, basically. So should this tiering actually incorporate some of the accessibility with regards to nationwide footprint alongside bill sizes? We do think that KBJ's footprint could represent a structural advantage that is not currently reflected in the sector's framing of Medi Asas, which still largely revolve around uniform margin risk, but this is our view. That being said, we continue to believe that KPJ does have the highest degree of operational flexibility within the sector to adapt to future structural healthcare reforms. Just lastly, we have touched on earnings. We lifted earnings by 9% on stronger operating metrics. All in, the DCF target price is actually lifted to 4.01 from 3.77 previously, implying 17.9 times FY27 EV/EBITDA, which is above its historical mean. I guess that's all we have for today. See you again tomorrow at Morning Kappa at 8. Thank you.